A global recession is imminent, and it's going to be worse than you think. I'm your host, Steven Van Metre, and thanks for joining me today. And with investors eagerly buying the dip despite Russia's invasion of Ukraine, investors are once again going to find themselves on the wrong side of the trade as the global economy heads into a recession. Let's pick this story up where we head over to the Wall Street Journal, who headlines that Russian invasion scrambles prospects for the global economy as financial markets reacted swiftly to the invasion, with stock markets dropping sharply in overnight trading and commodity prices soaring. The economic impact will depend on the scale of the fighting and the new sanctions that the U.S. and its allies have promised. Those penalties would come on top of more limited sanctions the U.S., the U.K., and the European Union have already rolled out against Russia in response to the Ukraine crisis. Extensive fighting and sanctions that disrupted Russia's energy exports, which is a key subject of today's show, would have an outsized impact on the European economy given its heavy dependence on Russian gas. Some European banks and businesses also have extensive ties with Russia. And that makes sense because, well, we're in a global economy and everybody's tied together one way or other. Let's continue on. As the price of oil surged above $100 a barrel in overnight trading, prices for commodities supplied by Russia, such as aluminum and nickel, that are already key inputs in the automotive industry, also leapt. Russia and Ukraine together make up a small slice of the world economy and represent only a minor destination of exports for Europe or the U.S. However, Russia is a major supplier of oil, natural gas, and other commodities. It pumps about 10% of the world's oil, and in turn, the EU relies on Russia for nearly half of its natural gas imports and almost a quarter of its oil imports. Meanwhile, Ukraine and Russia combined account for nearly 30% of global wheat exports, according to the U.S. Department of Agriculture. The nearby Black Sea serves as a major conduit for international grain shipments from Ukraine, and the country is also among the top exporters of barley, corn, and rapeseed. Now, what I want you to understand is this story is about energy and inflation, because what did we just talk about that are going higher? Energy and food. And what are two things that right now that people all over the world are going to be affected by? And it's higher energy prices, higher gas prices, and higher food prices, causing parts of the consumer price index to stay high while others are likely to come down. And those higher prices in energy and food, well, they're dangerous because that usually tips the world into a recession. Let's continue on. As wheat prices in the U.S. rose to the highest level since July 2012, on Thursday, Russia and Ukraine are bread baskets, exporting millions of tons of wheat to fragile economies in the Middle East, including Egypt, Turkey, and Lebanon. At a time when prices for energy and other commodities are already driving global inflation higher, any disruption of supplies from Russia and Ukraine could push prices even higher and weaken the global economy, particularly in Europe. And what happens in Europe is certainly going to happen here in America. Peace is a lot better than any kind of war from an economic point of view, said European Central Bank President Christine Lagarde earlier in February. And she's absolutely right. Peace is much better for economic growth because this, again, causes higher inflation, and consumers around the world are going to feel effects of this invasion, whether they have any interest in it or not. They're going to be felt by their pocketbook. Let's continue. As the Wall Street Journal then headlines, oil price surge threatens U.S. growth. With prices $100 a barrel, households in the economy are set to take a hit, according to economists. With prices topping $100 a barrel for the first time in nearly 8 years, the commodity is set to squeeze American households, push up inflation, and dent the economic recovery and create a new headache for the Federal Reserve as it moves to raise interest rates. And some people believe now that the Fed will hold back or slow down the pace of its increases. Well, due to higher inflation due to energy and food prices likely to stay up, well, it tells us actually the central banks are going to have to remain aggressive, which is not the popular view. Let's keep going because few economists say the U.S. is in danger of recession because of high oil prices. And boy, they could not be more wrong. But many expect U.S. growth, which already appears to have lost momentum this year because of the Omicron variant of COVID-19, to slow further if prices continue to increase. And let's debunk this oil issue because high oil prices usually cause a recession. Here you can see back in the early 90s, oil prices, WTI shot up, recession in gray. There you see high oil prices in the early 2000s, dot-com bubble, recession. How about the great financial crisis? High oil prices. Looking at 2015, we almost had a global recession, but what happened? Oil prices came down and eased financial conditions, but that didn't hold out because in 2018, if it wasn't for lower interest rates, we see that oil actually had to go down and continue down into the recession. And now people believe, and for some unknown reason, that high oil prices are good. But in fact, what I'm about to show you is how it's squeezing pocketbooks and is not a good sign for where the global economy is headed. And you can see the crude oil prices against real disposable personal income. And we go back now to the early 90s, and what happens? Disposable income is trending along, but crude oil prices rise above. And what does that mean? Energy prices, people cannot afford those higher prices, leads to a slowdown in spending, and you get a recession. And you see that trend again, oil prices rising up here, but the overall trend of real disposable income is just steady Eddie on this path. And that means, of course, lower oil prices into a recession, as, of course, we see high oil prices being a problem. Same with the great financial crisis. And we see coming here in 2015, the oil prices were too high relative to personal incomes, had to come down. And now we're seeing once again, the oil prices are headed too high and the people cannot afford them. And what does that mean for the stock market, particularly on a day where people are buying the dip? Well, look at the broad economy. And what do we see here is the GDP growth tends to go down during periods of high oil prices. And that means the global economy, the U.S. economy in particular, are going to slow. And when the world's largest economy, particularly the largest consumer economy, slows down, well, the rest of the world's going with it. And how about the stock market, which is particularly interesting on a day when investors couldn't get enough and came in and bought the dip in droves? Well, I got bad news for them, because high oil prices tend to also match declines in the stock market. So while they're cheering for high oil prices, well, they should get ready, because more volatility is going to be in the markets, sending prices likely lower. So the notion that we're going to see a surge higher in equity prices, well, is not validated by prior instances of higher oil prices. And how about the bond market? And we see the same story there. People once again believe that interest rates must go up. And what did we talk about the last 2 days about demand for loans? So we have this setup where speculators want to drive interest rates higher, but there's no demand, and people often misunderstand there is a supply and demand component to rates. So you can't just have infinitely rising rates if there's no demand for people to borrow at them. Because what does it mean from the bank's perspective? If a bank is lending at higher rates, it's a good thing. But if they're not lending at higher rates, well, what do they have to do? They have to buy more treasuries to back all those deposits. So it goes against what the speculators are doing. So as they're driving rates higher, demand is going down. And what does history show us? That when oil prices go up, well, that means rates are about to go down. And why would that happen? And if you think about it, because high oil prices, which are not being validated by higher incomes, tighten financial conditions. So how do you ease financial conditions? How does a monetary system do that? Through lower interest rates. And so everyone's got it wrong right now. They think rates are rising. They're ditching their bond funds, when in fact, they should be doing just the opposite, because here you can see every time oil prices are going up, rates turn and head lower, and likely direction of rates is indeed lower. And then how about today's Treasury auction further validating that? Foreign bidders took 63.9% of the 7-year note auction, despite what's going on in Ukraine. And let's look at some good news, perhaps for the U.S. economy, as U.S. jobless claims fall amid tight labor market. The total number of collecting unemployment benefits through state programs falls to the lowest level since 1970. Now, by the way, if you're concerned about your portfolio and what it means in a global recession, well, you shouldn't be. Be sure to check out Portfolio Shield. There's a link in the corner and the description below. You'll be glad you did. Let's continue on, because initial jobless claims of proxy for layoffs fell by 17,000 to a seasonally adjusted 232,000 for the week ending February 19th, down from the revised 249,000 from the week before. And that's a great sign, because continuing claims of proxy for the total number of people on unemployment rolls through regular state programs declined by 112,000 to 1.5 million for the week ending February 12th, the lowest level since 1970. And so what all of that means is that people that are losing their jobs are able to relatively quickly find another job. And that is a sign of a healthy labor market. It's a sign of a good economy. The only question now is, at what point does higher energy prices and higher food prices send consumption lower, and in turn lead to higher unemployment? Let's keep going, because consumer demand is likely to increase more going forward in areas that have been suppressed by the pandemic, like in restaurants, medical services, travel-related services, and services that are supplied in person, according to Erica Grosjean, economist at Cornell. Well, Erica, I got news for you. I think you're completely wrong by that view, because with equity markets down, high energy prices, high food prices, and high interest rates, well, that tells you that there isn't going to be a lot of economic demand. It's going to go the other direction. And with that, I appreciate all of you for being fans. Appreciate you watching. I'm Steve Van Metre. Bye now. The content of this video is provided as educational information only. Is not intended to provide investor advice. It is not to be construed as recognition, solicitation, buyer selling securities, financial instrument, or participate in any particular trading strategy. This video was prepared by Steve Van Metre. Personal capacity opinions expressed in this video that do not affect the values of Steven Van Metre Financial.